From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to another episode of the Macrocast. I'm your host, Ylan Mui. I'm Managing Director at Penta, and today I'm joined, as always, by Brendan Walsh and John Fagan of Markets Policy Partners. And we're also excited to introduce a special guest, Jeanna Smialek, a reporter for the New York Times. Jeanna covers the Federal Reserve for the New York Times. That's obviously one of the favorite topics here at the Macrocast. She's also the author of a new book called Limitless. The Federal Reserve Takes on a New Age of Crisis. The book is about the central bank's response to the pandemic and how much it stretched its powers. And that's actually, I think, a really great place to start our discussion because we spend so much time on this podcast talking about, is the Fed going to hike or hold or pivot or overshoot? But it could really help to take a sort of 30,000-foot view of how we got here in the first place. So, Jeanna, your book kind of covers the pandemic period and how the Fed threw everything it had at the economy during COVID. Now it's at a point where it has raised rates at the fastest pace in history and may have to actually turn right back around and cut rates again. How do you see all of these things being related, or do you think that they're related?
Yeah, absolutely. I think, the point of my book, and I spend a lot of time in the book sort of building up to this, is that the Fed's abilities and powers really expanded over the course of the 20th and into the 21st century in ways that made it pretty, incredibly powerful by the time we hit the 2020 pandemic. And that's why it was able to throw all of sort of the spaghetti at the wall, try all these crazy things that we had never seen it do before when the pandemic struck. And so sort of the point of the book, and I think the big takeaway for me as I was reporting it, was that the Fed has so much power that I don't think is fully appreciated and will probably be asked to leverage those powers again, was a big takeaway from the book, which very fortunately published 2 weeks before the banking crisis that we have just recently seen unfold, when the Fed, in fact, did start to use those expansive powers of it has again, and in a pretty creative way. And so, I think in the sort of long sweep of things, this is an institution that just can do so much more than I think most people understand, and really, is doing those things in pretty interesting ways in order to sort of shore up the safety of the financial system and make sure that the economy gets sort of back to an even keel.
One of the things, though, that I think we're sort of grappling with is that, while the Fed, pulled out all the stops during the pandemic, using the powers that it had accumulated over the course of recent decades, there are many critics on Capitol Hill and elsewhere who say the Fed did too much. It built up all this power, it flexed its muscle, and it went too far. And now it has to sort of backtrack. Do you think that the Fed has used its power responsibly?
Yeah, so that's a really interesting question. And I think actually perhaps the most interesting facet of this conversation is less about the special emergency tools that it pulled out and more about the bond buying that it did in 2020, 2021. I obviously spend a lot of my time as a reporter with the New York Times just sort of meeting with people on Wall Street and having lunches and, doing the rounds. And it's been really interesting to me to start to hear, I feel like over the last 6 months, I've really started to hear a lot of people questioning whether the bond buying this time, as opposed to the bond buying that the Fed did after the 2008 financial crisis, was somehow different, was somehow inflationary in a way that the original iterations of bond buying weren't. And I have yet to hear like a very coherent argument for why that would have been the case. Although some people will talk about like money supply issues, but I think it is the case that there's this questioning. It comes back to your point. I think there is this questioning about whether the Fed is doing things that weren't sort of historically all that normal, in that we don't fully understand, and that came back to bite us somehow, that it somehow helped to ignite this inflation, a combination of sort of really aggressive Fed policy at a time when fiscal policy, but the congressional policy and the White House policy was also quite aggressive, was pumping a lot of money into the economy, whether that combination might have somehow paired up to ignite the inflation that we're seeing now. And so I think there are going to be, I don't think that the ink is dry on this one yet. I think we're going to be asking these questions in the years ahead. It's just, in the grand scheme of things, we're 3 years out from this episode. We're still kind of in the middle of the inflationary episode. And I don't think we have a really coherent answer yet. We're not sort of 2000 Fed looking back on the Volcker Volcker era. I think it's going to take a decade, maybe longer, before we really have a full comprehensive understanding of what just happened.
And just to be clear, when you're talking about the bond buying program, you're talking specifically about quantitative easing versus some of the other maybe non-traditional types of asset purchases that the Fed undertook during the pandemic.
Yeah, absolutely. Because those non-traditional programs actually didn't end up being that big. So I think you will find very few economists who would argue that they were super economically important, in the sense that, while it is true that the Fed sort of dabbled into corporate bond markets for the first time, it's not like they were pumping huge amounts of money in there. It was really like they were doing that to keep that market from crashing. But the sort of economically relevant thing that they did was buy treasury bonds and buy mortgage-backed securities. And they did that in just astonishing scale. And so I think that that's what we're hearing people start to question. Was that too much? Did it go too far? Did it last too long? And I think that last point is one that's really salient to people right now. And so, like I said, we're still kind of writing the postmortem on this. And I think we will be for a while.
John and Brendan, do you guys have a view on that? And sort of what do you feel the impact of the Fed's QE during the pandemic was? And I'm trying to remember sort of where we are in QT, quantitative tightening.
Well, I mean, one of the things that we've noticed is Brendan and I were at a hedge fund back in 2008, 2009. And you saw, before quantitative easing really got going, you saw a lot of pushback on it, even in the early phases of it. QE1, way back then, in the annals of Fed history, there was enormous concern that it would be hyperinflationary. There were economists that signed a huge letter and so forth. And so I think that and it didn't bear out. We saw a lot of episodes of QE over a long period of time, and that period tended to be, disinflationary or secular stagnation kind of dynamics, which would coax the Fed back into QE. They could do those successive episodes because inflation was so low, and it became a regularized tool in the toolkit. I think that there's perhaps a little bit of revisionist history. There's, a lot of people that were sort of in that inflation camp said, see, I was right. QE is very inflationary, except QE 1, 2, and 3 weren't. But this one was, so I'm right.
I think we did a twist in there somewhere too.
Yeah, there may be some other aspects in there. Of course, the supply chain disasters during COVID, when you pair up QE with all of these other factors, it really goes to show QE is and bond buying has some very different dynamics depending on the macro backdrop and the context in which it's deployed. We've seen this in Japan. They've been doing QE. They're still doing, essentially those ultra accommodative conditions. And it's just, it doesn't seem to have any sort of one size fits all outcome.
What do you think is the impact of the Fed starting to, and now for a while now, pull that money back out of the system? Have markets reacted to that in any way, or has it been an orderly drawdown?
Well, QT always had a little bit of a strange narrative on Wall Street. The sell side would always say, QE, rocket fuel for stocks. Fed does QE, stocks go up. Well, what about QT? That's bullish for stocks too, because
it's always a good time to buy.
Right. And, the explanation was always, well, QT can only occur at a time when growth is really good. And, it's occurring at a time now when inflation is the issue, really. And so it's there's a lot of discussion about how the Fed is focused on rates, and it has focused the minds of the market on rates, and QT being this concept and this dynamic that we're not really all that comfortable with kind of operates in the background and is very, very difficult for market participants to account for.
We are still trying to wrap our arms around the inflationary period that we're currently in. But, Brendan, it does seem like there are some signs that inflation is actually starting to cool. CPI came in a little bit under expectations. I think it was the 10th consecutive month of slowing, I'll put it that way, slowing inflation. What are you seeing there? Do you think we've actually turned the corner?
I think definitely the inflation that was caused by the pandemic and the supply chain constraints, especially the goods side, that's completely normalized. And actually, a lot of those have turned negative. Now we're seeing a little slowdown in the service sector, but it's maybe a little stickier than people would hope for. We also got the PPI, the producer price index. And That is very, very encouraging. That is completely normalized and has really fallen off a cliff in the last 6 months. And actually, if you just simply take the year-over-year CPI and do a 2-month lag with the PPI, they track each other really well. So which is very, very encouraging for the future for the CPI, because that kind of is indicating that we should be coming back to somewhat 2 to 3%, relatively, not in the next 2 months, but probably by year end. The housing sector is also the way that it's measured. It's a kind of works with a huge lag for the CPI. While we do get real time data from places like Zillow and Redfin, so we know that the housing data is going to be coming off hard, and it will be a drag for the overall inflation. And for the CPI, that's 40% of the overall measurement. So I think the Fed can feel good that inflation's coming off. I think John and I really do think that they're going to pause, but I think where the market is wrong is in how quickly they think that the Fed's going to cut in the second half of the year, and we think that they're going to be more resilient in holding the front on that front.
And Jeanna, I would really like to hear your take on this. This is the hugest gap, or one of the hugest gaps in between in the macro landscape, really, where the Fed's rhetoric is and where Fed fund futures are pricing. Given what you know about the Fed and about how they're rethinking their powers or understanding what the impact of their powers might be, where do you come down on this? How does it reconverge?
Yeah, I think the Fed has actually been addressing this question a bit itself. Chair Powell basically got asked this during his latest press conference, and he said something to the effect of, we have a different forecast for the economy than the markets do. And I think that is a lot of where this all shakes out. The Fed sees inflation being quite a bit stickier than the market. The Fed sees the economy being quite a bit more resilient than the market. And so that seems to be driving some of that discrepancy. And so I think some of the convergence is going to happen in the actual economic data. If the Fed's more bullish bet is correct, I think that, we probably see a less pessimistic path. They don't cut rates, or I don't know if it's pessimistic or optimistic. I guess it depends on what your perspective is, but I could see a world where, if their path actually comes to fruition, I think they've told us they don't have any intention of cutting rates. If the market is right and inflation comes down faster and the economy sort of falls out of bed, then, clearly we're in a different world and things could be different. But, I do not envy the central bank or market participants their jobs right now, because it is such a hard world to predict the economy. There are a bunch of big risks looming on the horizon. I think, in the Fed's forecasts, how do you incorporate the risk of a debt limit default?
Right.
How do you incorporate the risk of a Ukraine re-escalation? There are a bunch. How do you incorporate the risk of a potential mid-sized banking crisis? There are a lot of wild cards out there.
No, it's important too, because just when we look historically, the Fed is awful at predicting Fed funds futures. But the only thing that's even worse is the market predicting Fed fund futures.
Well, I think that's a great place to take a quick break here. When we come back, we're going to talk about the Fed, of course. We'll keep that conversation going, but also dive a little bit deeper into the debt limit and what that could mean for the economy and for the Fed. We'll be right back. And we're back with the Macrocast. We're talking with Jeanna Smialek of the New York Times and John Fagan and Brendan Walsh of Markets Policy Partners. One of the big things that Washington is dealing with right now is whether and how to raise the debt limit ahead of this June deadline that the Treasury Department has laid out. Amidst all of the wrangling between Republicans and Democrats, it seems like the Fed often gets caught in the middle as a potential backstop to the economy if the worst happens, and as a potential even mechanism for crazy things like $1 trillion coin. Jeanna, what are you seeing from the Fed right now and how it's navigating these tricky political waters? Because they certainly don't like to be in the middle of the fight.
They do not like to be in the middle of the fight, but sometimes they just can't avoid it, right? And I think that this is one of those moments. They are in a tough spot because we have transcripts from some of the earlier debt limit debates, including 2011, that tell us that the Fed was sort of game planning for how to to mitigate the disaster if we went past sort of the point of no return, what we call the X state in Washington, that point at which the government can't keep up with all of its bills and we might actually have real problems. And so the Fed's eternal line is sort of, we can't save you from yourselves. You need to raise the debt limit. Like, do not expect us to solve the problems. But I think they're torn in between this very difficult situation where on one hand, they want to say, we don't have a plan. There is no plan. We don't have a plan. And on the other hand, they kind of put out the plan.
And what is the plan? What was the plan from 2011?
The plan from 2011 was multifaceted, but effectively they were kind of thinking through how they could shore up markets or protect markets against the fallout from an actual default on government bonds. And that could have involved a number of solutions. They could have done some sort of program where they swapped out those defaulted bonds for bonds that they already had in their portfolio. They could have outright bought defaulting bonds. They could have done several things. Jerome Powell actually at the time called those options loathsome. So, they're not like relishing the opportunity to do this, but it was pretty clear that there were some things that they could do. And we have planning for both 2011 and I believe 2013. But that said, I obviously have been talking to a lot of people about those transcripts, and there is a real sense around them that those were tabletop exercises. It's not clear that they would work. Like we may be taking a false sense of security from these planning documents. And so I think that they're in a sort of in between a rock and a hard place here. Like it's very difficult for them to say, we can't do anything. It's also, very difficult for them to communicate that they can't do enough. If we go past the X state, if we actually default on the debt limit, they're not going to be a silver bullet solution. They're not going to fix the problem.
It's also interesting that the Fed's next meeting is in the middle of June. So we could have crossed the Rubicon by then, or maybe be in the middle of rowing really hard, just sort of depending on how Treasury revenues come in. John and Brendan, are we seeing any indication that the markets are starting to get any more nervous about this? Janet Yellen, the Treasury Secretary, is going to be meeting with, I think, the heads of big banks next week to talk about staving off defaults. Are those warnings coming through?
We're really only seeing, the key dynamics of risk aversion on this in the very specific areas of the T-bill yield curve, which has been distorted and torqued around and contorted for a while around this. And, higher yields basically coinciding with where everybody's expectation of the X date is. And the credit default swap spreads for United States sovereign debt. And really, that's historically elevated, blown out well past the 2011 levels, in kind of emerging market territory almost. So those are kind of at extremes. But when you look at the broad markets, it's still, you can see barely a flicker, honestly. It's very difficult to see any sort of risk averse dynamic that's showing up in treasuries, which have been driven by the CPI and PPI data this week. We'll talk a little bit more about that. And, the ongoing regional bank and bank issues. These have, we've heard from a lot of our clients, I cannot structure my U.S. investment portfolio around this risk that is always solved at the 11th hour. And, it's a very difficult thing for investors to, even if they're concerned about it, it's very difficult for them to trade on it. And so that's one of that lack of headline grabbing equity market reaction is one of the dynamics that has traditionally been not that constructive for finding a deal between the two sides. It's not really much of a forcing mechanism.
Yeah, it may be that right now, at least in terms of the debt limit negotiations, no news is good news. We saw that the White House and congressional leaders punted a meeting that they were supposed to have on Friday to sometime in the following week. Neither side is saying a whole lot about what their positions are, but sometimes that can be a good thing. It's a sign that real negotiations are taking place instead of, folks just kind of coming out and complaining and not actually talking to each other. So we'll see if no news ends up being good news. But the other big debate that the Fed has been embroiled in has been around this sort of mini regional banking crisis. Jeanna, Republicans have criticized the Fed as, essentially taking their eye off the ball when it comes to bank supervision, of missing red flags. I'm trying to come up with even more sports metaphors as someone who is not doesn't follow sports very closely. How is the Fed navigating all of that? And how do they try to stay above the political fray? Can they stay above the political fray in this case in particular?
So this is actually really interesting as a Fed nerd who watches this institution all the time, because I think they've taken a really different tactic with this episode than they have in the past, in the sense that the Fed typically sort of avoids self-criticism with like great aplomb. Like they're very good at just like not criticizing themselves. And in this instance, they were basically like, yes, in fact, we did kind of take our eyes off the ball. We made some mistakes here. We're going to put out an entire review and say what we did wrong and what we're going to do about that in the future. Now, I will say, before we give them like a gold star for being self-reflective, part of the reason that that was possible, part of the reason that that happened is because Michael Barr, the current vice chair for supervision, literally wasn't the guy in charge when this happened. He's new. He replaced another person. So it's a lot easier to say like, hey, the last guy really messed this up than it is to say that about yourself, I think. Michael Barr's only been there he started last summer. So he was there for the very end of this, but not most of the period when these problems were sort of playing out. And he was pretty self-critical, pretty critical of some of the changes that the Fed implemented under his predecessor that he sort of pointed to in his report as having helped to precipitate the problems that have been rolling through the banking sector by helping to precipitate the failure of Silicon Valley Bank, which, as your listeners are probably aware, was the first bank to crash and sort of set off the domino line that we have seen since. And so, I think that the Fed is navigating this moment in a pretty interesting way, because they are saying, things that went wrong, we need to change, et cetera, et cetera. But they're doing that in a way that probably points to more bank regulation, more aggressive bank supervision, some things that the banks and many of the Republicans on Capitol Hill don't particularly love. And so it's going to be interesting to see how that plays through. Bank supervision is always a very difficult, political, thorny question for the Fed. We treat monetary policy as a very sort of politically divorced enterprise. That is not true for bank supervision. Bank supervision is kind of innately political. And so I think we're seeing that surface here.
So if the Fed is saying, okay, we messed up, we're willing to admit some fault here, what are they doing about it?
Well, we are still sort of watching to see how that plays out. It's a bit of a tough time because they are planning on doing quite a lot to make bank supervision and regulation a little bit tighter. They've told us that in these reports, but we haven't seen them introduce a lot of, advance notices of proposed rulemakings, which is sort of how you kick off that process of making regulation harder. And I imagine that is partially about the news cycle. It's a little bit of a tough moment to say like, oh, hey, we're going to make bank regulation tighter when you're still worried banks might crash and you're worried about the debt limit. And, it's a sort of a tough moment.
Conditions, yeah.
Exactly. There's a lot going on. And so, from the Fed's perspective, and this is pure speculation on my part, this is not reported out, but I do wonder if that's sort of weighing on their minds as they think about when to introduce the actual sort of rubber meets road rule changes here, because those are potentially market-moving rule changes. Like these are going to be the things they're talking about, the things they've suggested in this report, which include things like changing the accounting treatment for securities on bank portfolios for a lot of mid-sized banks. Like those things would potentially be pretty market-moving for these banks. They would matter for the banks. And so, I think that this is an interesting moment for them to try and navigate those various cross-currents.
Do you think the Fed makes any changes internally? Does it change itself if the Fed was partly to blame for what happened? Are they going to do anything to reform themselves?
Yeah, so that's an interesting question. I will say, and this is not pulling from the Barr report, this is pulling from my own reporting. But I will say that in this case of Silicon Valley Bank, which I think from the Fed's perspective is sort of the big mistake here, there was a much smaller and less professionalized team of supervisors overseeing that bank prior to just a couple of years ago, because of the way the Fed sort of has been doing supervision. Like they don't move up banks until they get quite large into more aggressive supervision. And so I think there is a view that a lot of the problems happened under that earlier supervisory group, and they're not the supervisory group currently sitting over that bank. And so I think they may think that it's simply to some extent, this is simply a matter of graduating people faster to moving them up quicker. And so I'm not sure that that's the kind of situation where, there's have been a lot of questions like, are heads going to roll? Are they going to fire people? And I'm not sure that's the kind of situation where you fire people. You might just kind of change your internal processes. And so, again, we haven't seen the end of this, but I feel like that's maybe where this is headed so far.
So I have a question on that front. So it was the San Francisco Fed that was in charge of supervision. So how does the San Francisco Fed work with the Fed here in DC? Does the DC oversee the San Francisco Fed, or do the regional banks kind of have a little more autonomy on that front?
Yeah, so that's a great question and so much more complicated than you would think.
Yeah.
As I have discovered over recent weeks. So technically, bank supervision is a delegated authority, which every Fed official will tell you, a delegated authority of the Federal Reserve Board. So like the board owns supervision, but allows the regional central banks to carry it out. And they do it on the board's behalf. And so everything eventually comes back to the board. But for smaller banks, quite a lot is delegated to these regional central bank reserve banks. And so what we saw in the case of Silicon Valley Bank is Silicon Valley Bank was growing very rapidly. And because of some changes implemented in 2019 and 2018, what we really saw was that they didn't move up to a bigger oversight level where their oversight was sort of being more aggressively overseen by a centralized committee that included people on the board until really late in the game. So they were pretty sort of myopically under the San Francisco Fed's purview. And those bank examiners who were seeing it, the supervisors who were in charge of it, were really sort of small to medium-sized bank supervisors. Yeah. They weren't bank supervisors. And so it didn't move up to the big bank supervisors until it was like well over 100 billion in assets, which is not like a small bank by any, like it was being overseen like it was like a tiny little bank, and it was actually a huge bank. And so I think that was a lot of what happened. Some of the slowness here probably owed back to that, according to my sourcing anyway.
Yeah.
Well, we could keep talking about this for another half hour, but I know our time here is short. I just want to ask Brendan and John quickly before we have to leave this here. Is there anything else on your radar screen for next week? I know that we've talked already about the meetings between the president and congressional leaders on the debt limit, the Treasury Secretary and big banks also on the debt limit. Is anything happening beyond the debt limit next week? Please tell us.
Yeah, well, we've got some interesting data actually coming out of China. So China, this has been sort of a theme this year that China was going to have outperformance. They've wiped away COVID zero. The Central Bank of China is back in the stimulus business, more fiscal support, very expressly, by Beijing and the leadership to try to get the economy up and running. But we've seen some very mixed signals. We've got the April data, the retail sales, industrial production, and so forth coming in. The trade data looked weak. Very interestingly, their credit numbers collapsed last month, which is something that is maybe 1 month is a blip, but you have to take a look at that and see where that's coming from, and if that's actually a trend, which would bear ill for the recovery in the second half of the year. So that's and Turkish elections on Sunday, very interesting there. It's a lot closer than people would have expected. This was
the first time in 20 years. Yeah.
So that will certainly be a potential market mover as well.
Great. So more politics around the world to keep our eyes on. Thank you to everyone for listening to the Macrocast. Again, I'm Ylan Mui with Penta. Thank you to Brendan and John from Markets Policy Partners for joining me. You also heard from Jeanna Smialek of the New York Times, and author of the book Limitless. Please go buy the book. You can find the link in our show notes. And also please remember to like and subscribe to the Macrocast wherever you get your podcast. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.